Hi there, welcome to Kneppy Invest, and welcome to my pursuit of high quality companies that are not listed on the ASX, focusing mostly on the Tokyo Stock Exchange, London Stock Exchange, and the NASDAQ. And in today's video, I'll be looking at a company that is listed on the NASDAQ, a company called Monolithic Power Systems, a company I've not heard before. Now, the reason I'm discussing this company is because I ran my high quality screener that I call Rule of 10, looking at companies that have revenue growth over the last 5 years above 10% per year, return invested capital and operating margins above 10% average over the last 5 years, companies that have a market cap above $100 million and excluding mining. And on the NASDAQ, we have 94 companies that satisfy this particular filter or screener. Only 94 companies, well short of the Tokyo Stock Exchange, by the way, which has the greatest number of companies, 120 odd or so. Anyway, so at the top of this list, and this is all listed by market cap, we have, of course, some of the highest quality companies in the world, including NVIDIA, Microsoft, Alphabet, Meta. Apple's not here. Apple is not here, by the way. I just noticed that. Anyway, what I did is I went down this list and I was just looking for companies I don't know much about, if anything. And also, I was looking at revenue growth, return on invested capital, and operating margins. And I was just picking a few out. And one of these companies was Monolithic Power Systems. This company jumped out at me. Now, it is in the semiconductors and semiconductor equipment. And this space has experienced some pretty good growth over the last 5 years. So it's not a shock that quite a few of these companies have had a really good 5-year period. Now, this company has a market cap of $40.7 billion. So what I'm going to do in this video is I'll briefly discuss what this company does, something to do with semiconductors, obviously. Then we'll have a look at the financials, financial history, and why this company satisfied my screener. And then we'll have a look at the chart. I'm recording this video on the 20th of August. So the chart is, or might be a little bit old, but not that old. Anyway, so this is Monolithic Power Systems website. And the funny thing is you can buy stuff. So do they sell stuff to the normal people? Because they have a cart here. You just buy stuff. Anyway, so power modules, integrating inductors, magnetic power, position and current sensors, monolithic ICs, and AC, DC power ICs. Whoop, all over my head. Wow, look at the amount of products they do sell. Battery management, motor drivers and motor controllers, isolation, power management, automotive, Class D audio. They have a lot going on here. Inductors, sensors, LED drivers. They also have a new product section, analog, data converters. So I'm assuming they develop and manufacture equipment for maybe not only the semiconductor industry, but also other industries as well based off this. So let's have a look. And if you want some of the stuff, if you want some monolithic ICs, you can go to their website, maybe buy some stuff. They also talk about the rare earth scarcity challenge. Looks like they're having a bit of a webinar on the August 26th, which is before you're going to be seeing this video. So that's pointless to you. Okay, let's have a look at what or how Fiscal AI describes this company. See if I'm on the right path. So they engage in design, development, marketing, and sale of semiconductor-based power electronic solutions for the computing and storage, automotive, industrial, communications, and consumer markets. Consumer markets, there we go. The company provides direct current, DC to DC integrated circuits ICs that are used to convert and control voltages of various electronic systems, such as portable electronic devices, wireless, LAN, access points, etc., etc. Incorporated in 1997 and is headquartered in Kirkland, Washington. And they have customers all around the world, looks like. The CEO is Michael Singh. And yeah, they're in the semiconductor and semiconductor equipment sector. Okay, now on to the financials. And this is something I do for every single company I'm looking at the first time. I just have a look at the overview in Fiscal AI, and I just want to see what I can draw out from the company. And a lot of times when I just have a look at this sort of page, I can determine fairly quickly if a company is a company I wanted to look at in a little bit more depth. And the first thing I look at is revenue growth. And if I don't see a company growing their revenue, I don't look at that company anymore. That's it. This is the number one thing the first thing I look at. If a company can't grow the revenue, that is a massive red flag for me. But Monolithic Power Systems does not have that problem. In fact, their growth in revenue over the last 3-5 years over the last 3, 5, and 10 years has been exactly what you want. We're talking about above 20%. Now, over the last 3 years, it's only 19.3%. So maybe it's slowing down, but beautiful growth in revenue. And this company has seen a little bit of scale and operating leverage because earnings per share has been growing at a significantly greater rate than revenue. Now, one thing they could have been doing is buying back shares, which would lead to earnings per share growing at a greater rate than revenue, because revenue is not per share. I doubt they're doing that, but more than likely, this company has seen an increase in margins over the last 10 years. And this is the effect of increasing margins. You will see earnings growing at a greater rate than revenue. So no complaints there. In fact, over the last 5 years, earnings has been growing at 69.4% per year. You're not going to complain about that sort of growth if you're being a shareholder. Now, next thing I'm going to look at is gross margins, 55.3%, operating margins, 26%. 1 year number, I do prefer looking at the last 5 to 10 years, but I would expect at least operating margins have been increasing over the last few years at least. And I still think it has potential to grow even further, maybe. Return invested capital, 51%, return equity, 32%, 5-year average, exactly what you want to see. Dividend yield, 0.8%, payout ratio, 14.6%, low dividend. And I think the dividend is just a bit of it's just a token dividend. You're not buying this company because you want income, and that's exactly how this sort of company should do it. Payout ratio, 14.6%, exactly what I want to see it. So, and the growth in dividend, 25.6% over the last 5 years. So if you buy some shares in this company right now, there's a chance your dividend yield on your initial capital will be quite significant, another 5 to 10 years. And I think a lot of investors don't realize that. Dividend growth is really important, even for these companies who have a very low dividend yield. Just be patient, and eventually. And not only that, your capital will grow significantly along with it. Now onto valuation. Oh, by the way, debt. Looks like they have no debt. No debt. In fact, they have net cash about 1.13 billion. So that's good as well. I like that. Okay, now to valuation, 21.5 P ratio. Okay, that's interesting. Forward-looking P ratio is at 44.5. So the market's either expecting a bit of a decrease in profit, or maybe there was a one-off in the last year. So that's interesting in itself. You can have a look at the bulls and bears. So sometimes I look at this, sometimes I ignore it, but I won't do it here. If larger analog peers like Texas Instruments or Analog Devices committed resources to matching this company's process technology, this could hamper the latter firm's growth. Now, I don't like when they say if Meteor was heading straight for Earth, this company is not a long-term investment. If the sun suddenly exploded, company is not a long-term investment. If, I don't like the words ifs. It's it's speculation. It's just speculation. You just don't know. So I don't like when people or analysis use the words if, because how many ifs are there? There's a billion ifs. So sorry about that, whoever mentioned. Well, again, this is Morningstar, and I don't have the biggest time for Morningstar analysis or experts. Okay, now to the financials. So I'm a little bit interested to see why the P ratio is at 21. That seems a little bit low. Why does this happen? Why does this happen? Sometimes, I'll have a look. I'll get rid of last 12 months. Well, what did I do? Okay, there we go. Okay, so what I'm going to do is we'll have a look at revenue and income. If I can find it there, where is it? Consolidated net income, there it is. And we'll also have a look at gross profit margins and operating margins. And what we'll do is we'll just have a look at growth in, why is that not a different color? So annoying. It doesn't really matter. The main thing here is this company has been growing really nicely over the last 10 years. In fact, revenue has gone from 333 million to 2.5 billion, and profit's gone from 35 million to 1.8 billion. Now, the one thing I don't like here is we have seen, and what I'll do is I'll get rid of the last 12 months, and I can now see why the P ratio looks really low. This company had revenue of 2.2 billion and profit of 1.8 billion. There must have been a one-off in their profit for last year because those margins from revenue to profit looks a little bit too high. And so there is definitely one off, and that probably explains why the P ratio looks really low and why the forward-looking P ratio is significantly higher, because expectations are that the profit will drop. So this is not the underlying. I have a feeling this is not the underlying profit. This is a reported profit, which makes sense. And so we can have a look to see why there was sort of a one-off in profit. And provision for income taxes, 1.2 billion. Take that away, and profit was more like 500 million. Okay, so we'll say profit is about 550 million. And that makes sense. So profit is still increasing from last year, but only at 550 million. Now, that's interesting because if we go back and have a look at the valuation of this company, so P ratio or the market cap is 400 million, profit of 500 million, which means the P ratio of this company is about 80, not 21.5. There you go. So you have to be careful about those sort of one-offs. Provision of income taxes is not something that's going to be on their books every single year. So be aware of that sort of thing. And it sort of really screamed out to me there was something wrong just by looking at this chart, which is why I do this. Now to margins. I'm expecting operating margins to be increasing. Gross margins maybe not, but gross margins have increased. Well, they've been decreasing the last 2 years, but over time they've been increasing. No shock there. And roughly between about 54, we'll say 58%. And I'm expecting operating margins to be increasing quite nicely over the last 10 years. And yeah, exactly. In fact, operating margins have doubled, almost doubled, exactly doubled from 12.3% to 24.4%. There has been a bit of a slip in both margins in the last few years. So that's something to keep an eye on. We don't want to see that continuing. So that could be a slight red flag, possible red flag. We'll just say possible red flag at this point in time. Okay, next thing I want to look at is we'll have a brief look at cash flow. I do like to look at this on occasion. And you can see here, look at the operating and free cash flow, significantly lower than profit. So yeah, this is exactly what you want to see. Now, the reason I do look at this is sometimes when I look at the some of my valuation metrics like free cash flow yield or EV to free cash flow, if you do see any sort of weird numbers or weird years, that could affect the free cash flow yield and EV to free cash flow. So I just want to see if there's possibility of that. And I say probably not at this point in time. Now, another thing you can look at with some of these is just the quarterly numbers, but I'm not going to do that in this particular instance. Okay, free cash flow. Next thing I'd like to look at is simply return on invested capital and return on equity. How's this been changing over the last 10 years? Now, a significant increase in the last year, and that's probably because of that one-off in profit. So I think we can ignore that year. That's a little bit silly. Now, otherwise, this company has been increasing their quality metrics quite nicely. In fact, there was only 1 year when one of these metrics was below 10%. That was in 2015 when return equity was at 9.8%. But since then, growing really nicely. So there was a little bit drop off in 2023, but otherwise, yeah, no red flags popping up right there. Now onto valuation. Now this one's going to look weird because I do like to have a look at P ratio, but if you have a look at P ratio, it's too low. It's too low. That's not the real P ratio of this company. In fact, what we'll do is we'll go to the last 12 months to include now. So P ratio is not, it says 22, but it's not that low. And you can see it dropping because that one-off income tax provision. So I said the P ratio is more like 80, which sort of is normal for this company. If you have a look at the last 10 years, P ratio of 80 is normal. Now, the P ratio oscillates between 120 and 40. So I'd say 40 would be a good time to buy, and it hit 40 back in 2022, which is understandable, and has been as high as 100 a few times in the past as well. So 80 sort of in between the normal range for this company. So that's just the P ratio. We'll also have a look at free cash flow yield, EV to free cash flow, and EV to EBIT. Now, I'm going to look at free cash flow yield. No, we'll have a look at these separately because it's a little bit too messy. Free cash flow yield currently at 1.75%. And again, not overly small, not overly small, which means overvalued, and not overly large, which means good value. Now, it wasn't that long ago when the free cash flow yield was almost 3%, and that is on the high side. In fact, whenever you see this free cash flow yield get above, say, 2.2%, it usually peaks and then falls away. So that would be my aim for this company in terms of free cash flow yield, above 2.5%, a buy. Currently at 1.75%. Also, EV to free cash flow. Let's see what we see here. And about 56. It is on the low side, but not overly low. And does look like around 40 for this particular metric would be really good buying. It's only happened 4 times in the past 10 years. And finally, EV to EBIT. And this should also be fairly similar than what we saw in PE ratio at 60, no, not 60, but the number, but sort of in between the low and the high point. So looks like the EV EBIT ranges between about 30 and 110. And right now it's about 60. So somewhere in between, which sort of fits in with what we're talking about PE. And this also shows you that, yeah, just looking at the profit of a company can lead you down the wrong path. So be aware of that. Okay, now onto the chart. And this is the weekly chart for the company. And straight away, this screams out high quality. This is sort of company you want to own for the long term. Now, it looks like they listed back in 2005. And originally, the first 10 years, not much happening. Share price was increasing, but not really the chart of high quality. It became more of a high quality company back in 2012, but you wouldn't have known it back then. Maybe once you went into 2014, 15. And since then, the share price has generally remained above the 200-week moving average. It fell below briefly in 2022 and briefly during April. That was the time to buy. And the share price has recovered quite nicely since then. So that's Monolithic Power Systems. Chart looks pretty good. The weekly chart looks pretty good. Daily chart probably looks pretty good as well. Yeah, the daily chart looks pretty nice. No complaints there for this company. Okay, so definitely another one to put on your radar. Monolithic Power Systems. Okay, that's it for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.